Namaste and welcome to the Smart Credit Classes with Sangeeta, where we simplify MSME finance and credit analysis step by step. So, whether you are a finance student, banker, credit professional, or an MSME entrepreneur, you are in the right place to build clarity and confidence in finance. This is part 6 of our CMA report series for bankers and credit learners. Today we will understand the TOL by TNW ratio, which is one of the most important ratio that bankers use in their MSME credit appraisal. Yes, this number also can decide often whether a proposal gets sanctioned or pushed back for reconsideration. As usual, grab your chair, pen and paper and let's discuss how TOL by TNW ratio is an important ratio every credit officer, banker and business owner in India should know. So TOL by TNW ratio, this sounds a little technical, right? But don't worry, by the end of this session, you will be teaching this ratio to your colleagues. Let's get started. So what is TOL by TNW ratio? Let's start with the basics. TOL by TNW stands for Total Outside Liabilities divided by Tangible Net Worth. You can think of it simply like for every rupee of my own money in the business, how much have I borrowed from others? Simple, right? Okay, let's understand this with example. Just imagine a traditional taraju. You call it in English balance scale. On one side, you have your own investment, right? Uh, and retained profits. And on the other side, of this taraju or balance scale, you have all your borrowings, bank loans, supplier credit, everything you owe to outsiders, right? Simple. Now let's go further. What components are included in TOL, that is total outside liabilities, and TNW, that is tangible net worth? We will break it one by one. These are bank loans and your overdraft limits, trade creditors and your suppliers, accrued expenses, provisional and other liabilities, and deferred tax liability. In simple, your long term and current liabilities both, right? Long plus current. Okay. Now, what components are included in your TNW, that is your tangible net worth? This is your share capital. Only the paid up we include in this. Your reserves and surplus, retained earning, that is your profits. But in this we minus your intangible assets like your goodwill, deferred expenses, preliminary expenses, or any fixed assets, right? Sorry, this is a mistake. Okay. Now, invisible assets don't count here, right? Because in case of trouble, they cannot be realized. That is why we don't count intangible assets like goodwill. Hmm? Now, this is what this ratio captures, right? It gives banker immediate comfort on whether the business is over dependent on external liabilities or whether the promoters are also putting their enough skin in the game. Now this ratio tells us how much liability the business has taken on compared to the promoter's own money, right? Let's understand again this with an example. Suppose there is one businessman, his name is Rajesh. He runs a textile industry, or you can say a business shop, and his TOL by TNW ratio is suppose if this ratio is 2:1. Okay, now what do I understand by the ratio 2:1? This means for every 1 rupee of his own money, he has borrowed rupees 2 from others. Clear? Let's move further. Okay. Now, why does even this ratio matters to bank? Now let's put on our banker head and then decide. Okay, when a credit officer sees your CMA report or your projection, this ratio is among the first things he examines, right? First thing is it helps them in risk assessment. It immediately tells the banker how leveraged the business is. A high ratio means high financial risk, and it also tells your repayment capacity. Lower ratio typically means better cash flows, and there is better cash flows are available for the debt servicing. And the third part is collateral coverage. This indicates how much cushion exists if your assets needs to be liquidated, right? So let's interpret this ratio, and this is the most important part, right? On, you can say, interesting how we read this ratio. So if this ratio is less than 3, bank usually consider it comfortable for SMEs and corporates, and sometimes in maximum bank this ratio is 4:1, right? And now if this ratio shoots higher, say 5:1 or 6:1, it means business is largely dependent on creditors and external funds. High leverage and higher risk for these lenders. I have also seen in my career that some people have more than 100 ratio, means their full business is dependent on the external borrowings, and this is very dangerous for a banker. Straightforward bank will say no. So always keep this ratio within benchmark. Now, in Indian banking context and RBI, different banks have their different prescribed benchmark. And this ratio also depends on the industry norm. For example, capital intensive business are sometimes allowed higher ratio, whereas the trading firms, they are expected to maintain a lower ratio, right? Now let's learn how to do step-by-step calculation. Okay, tangible net worth, that is your shareholder equity, or you can say capital, is 50 lakh, and a customer has borrowed term loan of 1 crore, his working capital limit is 75 lakh, and creditor and other current liabilities are 25 lakh. So now let's add all. The total outside liabilities 175 plus 25 is equal to 2 cr, and the tangible net worth is 50 lakhs. Now 200 divided by 50 is equal to 4. Acceptable, right? This is within limit. Now if this creditor rises from 25 to 75 lakhs, imagine this total outside liability will go to 2.5 cr, right? Now what will be the ratio? 5.0. Now this is over leveraged, never acceptable to bank. Okay, now let's understand bankers risk assessment framework. If the ratio is 2:1, green zone from a banker side, these are conservative projects and low risk for bank will easily finance them. If this ratio is 3:1, these come in yellow zone, and banks say this is moderate risk, and these are acceptable to banks with some condition that you cannot withdraw your capital during the tenure of the loan. Whereas this 5:1, this is red zone and high risk as per RBI guidelines, and this raises the red flag. If you are a fresh means a new startup, or you are a fresh new customer, the bank will straightforward say no. Now how can a business owner improve his ratio? So for banker, TOL by TNW gives instant insight into how much stake the owner has and how stretched his external liabilities are, right? It reflects commitment, capacity and cushion to banker. Right now for business owner, the message is completely different. If you want the bank to trust you, you need to increase your tangible net worth by just infusing fresh capital or retaining profits instead of withdrawing. You can reduce your fixed shares, intangible assets in the balance sheet. This ratio is not a banker's tool, it is a mirror for promoters also, right? Now how can you reduce your TOL by, that is your total outside liability? You can convert your advances into equities, that is your unsecured loans. You can convert them into quasi equity. We have discussed in debt equity ratio, you can go there and check what is quasi capital, right? Now you can prepay your expensive loans, improve your collection cycles, that is your creditors, negotiate better terms with suppliers, right? Now it can also improve by increasing your tangible net worth. You can retain more profit instead of withdrawing more. You can bring in additional fresh capital. This is fresh capital. Okay, you can convert your loans into equity. We have told you that quasi capital, and asset revaluation sometimes only recommended when it is applicable. Okay, Now, what is the difference between debt equity and TOL by TNW? In debt equity, in my previous video, I already told you that debt equity only considers long-term debt versus equity, whereas TOL by TNW considers all liabilities, including your short-term and long-term liabilities, right? This is why TOL by TNW is also a more holistic leverage measure for banks. Now, here are some tips from me for MSMEs how they can improve. We have discussed it earlier. Now, let's recap only. You can infuse more equity and retain capital in reduce dependence on your trade creditors. You can convert your unsecured loans into quasi capital or equity, or you can gradually repay your debt and avoid over leveraging. Always remember, if your TOL by TNW is too high, your loan request may get reduced or even rejected. So you need to be careful for this ratio. Now here's a quick banker's checklist. Are your unsecured loan shown as equity? Are your guarantees or your LCs included in your total outside liabilities? Are your intangible assets deducted from your net worth? Or is the ratio within bank sanction norms? This is a credit officer must check before proceeding for any loan. This ratio often decides whether your proposal passes or the financial discipline test. It doesn't mean you just take papers you ask from customer and you haven't checked this ratio. Before moving forward, just give a quick review. It hardly takes 30 minutes to check all the ratios, right? Now let's sum up this video. Now, what is dual by TNW ratio? Is one of the most critical leverage ratio. I already told you this. This is most critical ratio, leverage ratio in credit appraisal. It ensures promoters are sharing the risk and not running the business only on the borrowed funds. Now, in my next episode of the CMA report series, we will cover working capital assessment. Many of want to know, and this I will cover the most practical and misunderstood part of MSME loans in this. So I request you not to miss it. If you found this video helpful, do like, subscribe, and share this. And tell me in the comments what TOL by TNW ratio do you usually see in your industry. And please don't forget to watch earlier parts of this CMA series. Links are in the description. And thanks for watching Smart Trade Classes with Sangeeta. Don't forget to subscribe, share, and keep learning, because a smart credit decision today builds a stronger